Uh, Welcome everybody to our first Zoom webinar for clients. So we've entitled it Beyond 2020. Obviously this year was a incredibly interesting and difficult year in many ways, and not the least of which was to do with investment markets, and navigating through that. So hopefully today what we'll do is give you a sense of how we dealt with the year that we had, and in particular we've got a very special guest and member of the First Financial Investment Committee and well-renowned asset allocator Tim Farrelly to take us through the second half of the presentation, just to see what the outlook is from here. So the agenda is something like this. I'll probably take the first 10 minutes just as an introduction, and a few slides just to introduce the investment committee and a bit of philosophy and also what we did this year. But then I'll pass over to Tim, who will expand on an economic and market outlook. And we do have the final 10 minutes reserved for any questions or issues to wrap up. Just as a bit of housekeeping, just at the we hope that this is at the bottom of your screen, that what we there's a little Q&A button, so we'll be using that as the way that we can take questions from all clients, and we'll do our best to either answer them directly or at the end of the webinar. So please see if you can navigate down, find that little logo, and if you can click on it, you can type some questions in there that we'll keep an eye on. Okay, just a little, obviously the general advice disclaimer here, just to say that this is advice is of a general nature. So please, obviously it's no substitute for personal advice. It takes into account your circumstances, so just ensure that you make sense of this with your own advisors. So who's the investment committee? I thought it'd be a good opportunity just to introduce those. For those who didn't know, we have an investment committee. I'm sure you all do, but these are the people that are involved, which in some respects, I think we've often said that as a business, we're a nice size. We're not so big that we're a behemoth and like the banks, but we're large enough to do things like have an investment committee. So I'm the head of the committee. We have a really good mix of people within the business, be they partners or advisors or client service managers, compliance as well. Importantly, we have two really good members who are essentially experts and independent from the business. So I think that is really important. In Andrew Doherty, who is essentially main role is to help select our direct equities, and of course Tim, who we've got here today, as our asset allocation consultant. So what is the role of the investment committee? I guess these are the key parts of it. It's our job to sort of design and propose what investment policies we use. Importantly, I guess you don't want your advisor sitting at their desk having to make sense of all markets and make decisions on their own. They hopefully get most of the work done from a central hub, which is the investment committee, and they can just use that to then apply to client portfolios. So obviously the key thing is to guide advisors. It's also important to help them, give them the tools to help them implement any policies that we have. So again, there's lots of work done about how do we effectively implement all of our policies and practices. It's also important to be ahead of trends. So really what we do is we spend a lot of time analysing the industry, whether it be through investments or different types of investments and platforms and things like that. So again, hopefully we're at the pointy end of what's happening in the industry. Our operating rhythm is monthly, so again, that just allows us to resolve all contemporaneous matters and publish minutes model portfolios and the like. And of course, it's a two-way communication hub. So obviously there's questions that come from advisors and clients, and then obviously the guidance that comes back the other way. So we want to be as consultative as we possibly can as an investment committee. Just by way of introduction, we've got, I thought we'd put some photos up. You'll see Tim in a minute. Andrew obviously is, he's got a fairly long and storied background as well. Was head of Morningstar Equities for 14 years. Was an investment banker before that. Lots of qualifications. So obviously his strengths is in stock picking, and he's really helped us to build our APL with good stocks on it. And of course, Tim has worked with WHK, which was one of our predecessor firms for a long time. So he's a very long relationship with Tim, and we're very happy to have him back and helping us out as an investment committee as well. But obviously, you can see there that Tim's credentials are well and truly without question. So we're very lucky to have Tim as well. Just thought I'd spend a bit of time. I know this, you've probably heard from your advisors about the buckets to death, but it doesn't hurt to talk about them, a lot. And I just thought it'd be an opportunity to reiterate how it is, what is our investment philosophy. And I think these two things are key to it. We try to tailor our investment philosophy to client circumstances, and by that we mean probably what cash flow you need. So if you've got a corpus of capital, what is that bucket of capital need to produce? And that just helps us to tailor an investment strategy around that. But of course, the second piece, which is your attitude to investment, is really important too. If you can't feel comfortable with your strategy and how it's going to behave, then chances are you won't stick to it. So therefore, that's a key element as well. But it's only when you get a marriage of those two things do you find something that probably works. So there's two major types of assets. You have the defensive variety, which is essentially, you could say that they don't carry the market volatility. They're a bit of a war chest, if you like, against periods like we've had this year. So cash, fixed income, and enhanced yield. And then you have the growth variety, which is where we hope to get our long-term returns from, both from an income and growth perspective. But they do move around a bit, and particularly in years like this, this is where you can sort of have major correction in prices. And if you don't marry those two, defensive and growth parts, together, you can end up with a strategy that has problems. So if we look at the next sort of what we expect to happen, and this has essentially come from our forecast in terms of income and growth, and these are sort of round numbers. We can see that in the defensive bucket, there's not a lot of income there. It's pretty anemic and pretty low, but it does have an important role, and we've seen it this year in that it's there when you need it, and so that we don't have to be a forced seller in that growth bucket. But even with low returns from shares and property going forward, what we're usually seeing, there is still enough of a premium over those defensive buckets for that to be the driver of our long-term results. But I guess the bit we're most passionate about with our philosophy is what we're going to talk about next, and that is it's how we manage the cash flow through, and particularly this is relevant to retirement, not so much in the accumulator part, but if you had and it's got to do with the difference between a diversified fund and also what we would call the buckets, which are, it's obviously a well-used philosophy, and you should be well aware of it. So someone in retirement who has a diversified strategy, like a balanced fund, they would have to be, in order to pay themselves, they would have to cash in units. And what that really means is they're proportionately selling a bit of each of this wagon wheel, bit of property, bit of shares and everything every time they do that. And of course, the market wiggles around like it does up here, but like we're seeing this year, if we in a declining market, we're in a trough, and at the same time we're having to sell units, what you get is a bit of a disproportionate effect, and some call it sequencing risk. But basically what it means is that you're getting a double whammy. You're cashing in more and more units as the market's going down, and the markets ultimately will recover. But if you do the wrong thing, you might not have the units to recover with, and that's the real issue there. And I guess what we would prefer both in that sort of pre-retirement and retirement phase is that you split your money into buckets. So again, your circumstances up here, the cash flow is important, because what we would suggest is, let's have a year available in cash, years 2 to 4 in what we'd sort of say is moderate assets or low to moderate assets, such as the fixed income enhanced yield. And then we reserve our growth bucket so that it's protected and we don't have to call on it for a minimum of 5 years. What also, and this is obviously dependent on how much you're drawing down. The more you're drawing down, the more you're going to need in bucket 1 and 2. We could also augment this a little bit by feeding the income and dividends from the first 2 buckets into the cash bucket, which obviously probably gives us a bit longer. And the reality is there's not too many market situations where we've had to wait, where that 5 years hasn't got us through most of the nasty periods. And so, as opposed to the diversified strategy where you might have decimated your units on the way down, what we would hope here is that even without the crystal ball to pick when the markets are going to move around, we would still have preserved most of our shares or property units in the growth bucket throughout a difficult period like we've seen this year. So when we say how we apply this year, it's simply by what I've just said. We've stuck to our philosophy. We've stuck to our guns. We've tried to ramp up the communications a little bit, which we've hoped you've found useful. So lots of things such as impact of coronavirus, Friday the 13th, extraordinary time marks, all these things that we've been publishing, hopefully give you a common sense feel of how we are viewing things while we're in the heat of battle, I guess. So I hope that ramp up communication's been helpful. But importantly, I guess, we stick to the fundamentals. We try to avoid the emotions and the noise, and our buckets are core to this, but within that, we're trying to take away the emotion, the fear, and the greed, and just value things based on long-term fundamentals. Those two things, and simple diversification, all those portfolio construction principles is what we hope holds people in good stead. And that's really what we've been doing all through the year. However, that's the past. So we're now going to pass over to Tim. So what I might get you to do, Tim, if you don't mind, is request control. And the next slide ought to be your presentation.
Right, I think this hopefully will work. Yes, we do. Excellent. Thanks, Graham, and thanks everyone for joining us. What I'm going to try and do today is give us a run through what are some of the really big picture things that we're looking at the moment in terms of investment strategy. I'll also dive down a little bit into the weeds to just give you a flavour of some of the micro things we do as well, just to get a sense of what are we doing and why right now. And in doing that, I'm going to touch on these key themes that are driving the portfolios today. The first one is this recession that we're in that's been caused by the coronavirus is likely to be short, deep, well, we're seeing that right now, and V-shaped. The second one is we're pretty confident that we're going to see better returns over the next decade out of shares of commercial property than where we compared with TDs. And Graham touched on some of that earlier on, and it's the discussion we're always having, because most of the time you should expect to get better returns out of shares and property, but not always. There are times, occasionally, it's not often, where markets get overly excited and get to a level where you look at it and go, really, there's a strong chance that over the next even 10 years, we're going to be better off in term deposits. And that's how we think about value. Critical to that is you'd say, well, one, it's not going to be hard to beat TDs at the moment because you're getting 1% or less. But we think that interest rates, including TDs, obviously, aren't just low now, but they're going to stay low for decades. And I'm going to talk a little bit about that. I think they can creep up a little bit, but not very much. And that's really important for our investment strategy. And the final one I'm going to touch on a little bit is how it's worthwhile at the moment looking at a little further along the risk spectrum in your defensive part of the portfolio, just simply because TD rates are so low, and we'll talk about that. So firstly, oh yes, I'm sorry, one more thing before I get into it. The process we go through is firstly, try and forecast long-term returns, and I'll take you through how that works. Then we compare the returns we get in our forecasts with TDs. We also look across different markets. There's some markets look much better value than others. And the most important thing we do is we avoid markets that appear to be overpriced. And the key measure there is, are we getting better than term deposits? Now, for most of the last 10 years, markets haven't been overpriced. And so probably for most of you, you wouldn't have seen too much in terms of us saying we really need to sell out of this market, because there really hasn't been much requirement. We are now seeing some real strength in markets, and I think there's a reasonable chance that sometime in the next 2 or 3 years, we might actually get into this overpriced territory, and that's something you definitely want to avoid. So the forecast process. As we look at it with Australian equities, we break our forecast returns basically up into 3 things. We start up with our dividends, and then which at the moment for Australian equities are about 5%. That includes the franking credits. And that 5.1 is what we think we'll get from dividends on average over the next 10 years. The next 2 pieces are what makes up growth. And the first one is, how fast do we think companies can grow their profits? So if you're running a company and you can grow your profits at 3% a year, as per this example, you would expect the value of your company would also grow at 3% a year. And that's broadly true. But the one extra piece around that is sometimes markets are prepared to pay more for $1 of profit. Now, the jargon we all use is it's a price earnings ratio, but I think a better way of thinking about it is, how much will the market pay for $1 of profits? Currently, the market's paying almost $21 for each dollar of company profits. That's relatively high, a little bit higher than usual. We think on average in the long term, with interest rates at about where we think they're going to be, something closer to 17.5 is the right level. And so we expect that over the next 10 years, we'll see the amount that the market's prepared to pay for each dollar of profit to drift down somewhat. And that has a negative impact on returns. On the other hand, if we were buying shares at a price earnings ratio 10, in other words, we're paying $10 for every dollar of earnings, and thought it was going to go up to 17.4, you could expect a substantial boost from your earnings there. Basically, the difference between 17.4 and 20.8 is about 18%, spread out over 10 years, and they're all 10-year forecasts. It adds out a drag of about 1.8% per annum. And we end up with this return of 6.3, a little bit under the number that Graham mentioned earlier. And that's really in response to, we've had a pretty substantial move in markets even in the last month or so. So this number will go up and down as markets go up and down. So for example, if the Australian market, for whatever reason, went up by 10% tomorrow, you would say our dividend yield would go down to something like 4.5, but also our price earnings ratio would go up to something approaching 23. And so we're getting less out of dividends, and also that valuation change, the impact of the falling price earnings ratio would become bigger, and our expected returns go down. And that's basically how the forecasting process works. We apply that across a range of different markets. And what you see at the moment there is kind of an interesting picture, I think, where most of the forecast returns on the growth assets are similar. Typically, this is a reasonably accurate process, but 6.3, 6.7 is effectively the same number. 5.4, 6.3, close to the same sort of number. It's plus or minus. The critical piece here, though, is all of these expected returns are well in excess of what we expect to get out of term deposits. Now, you might look at that term deposit number and say, well, where can you get 1.5% from a term deposit today? And of course, you can't. The term deposit rates are more like 0.8. But we do think interest rates are going to pick up a little bit somewhere over the next 4 or 5 years. And so on average over 10 years, you'll probably do better than the 0.8% that you're getting today out of your term deposits. So that's basically where we think returns are going to be. That's our base case scenario. The numbers aren't high, certainly compared to what we're used to, but 6 and 7% is a decent premium above what we can get from term deposits. And that's actually about in line with history. So in terms of historical returns, that's not far from the mark. Now, the big issue, of course, is the COVID-19 crisis. The slides I'm about to take you through is the analysis we did in March and April this year, and started thinking about, well, we expect to get this V-shaped recovery with a reasonably quick turnaround, but it could get a whole lot worse. So we talked about 2 different scenarios. The first scenario we called the short, sharp shock, and we were saying basically that V-shaped recovery would come about if we got quick, accurate testing coming around quite early. The idea was if there was a test available, that you could basically put a swab underneath your tongue, have a look at it, everything's okay, I go to work. That clearly hasn't happened. Second piece we thought was very important was the government policy allows businesses to effectively go into hibernation. So can we shut down without going broke? And I think the JobKeeper has done a wonderful job at that. And the other thing then is, well, will the social distancing programs slow growth rates in the short term? So all of those things we were basically saying, if we get that, we're going to get a quick recovery out of this. The second scenario, which we called the Doomsday Scenario, which was basically things never actually quite get better. And the things we're looking out for there, infections keep on rising, until cures and vaccines arrive. The social distancing lifts too early and we get a big relapse, another shutdown, and then perhaps another one. The next 2 are really the important ones, where businesses start to fail and you get this dog-eat-dog environment. Now, particularly what we're thinking about there is the behavior of the banks. Often during recessions, banks become ultra-conservative. If you miss a payment, they want to scramble to get you or recover whatever they can of your assets. This time they're playing really nicely and giving people holidays in terms of loan repayments and trying to give them every opportunity to recover. If that starts to fail and the banks panic, that could turn around very quickly and get quite nasty. And important to that is, does government policy fail? Do they lift the support too early? So where are we now? This is how we were thinking about it back in March and April. Get the slides. Here we go. So right now, we obviously never got the test. That one certainly surprised me. I thought that would come about much more quickly. And that, I think, has helped slow down the recovery a little bit, certainly compared to how I was thinking about it in March and April. The government policy I mentioned before has been absolutely spot on. The huge amount of money they put out in stimulus, which is effectively paying money to allow to keep people in jobs or to let them meet their commitments, I think was spot on. They sprayed the money at about a little bit too loosely, but I think it was much more important to get something done quickly than have it perfectly targeted. And what we're seeing now is they're gradually withdrawing that support, but they're doing it by taking away mostly the untargeted money. So I give the government policy a huge tick for how they've managed to regulate, not just here in Australia, but in most places around the world. That's in terms of the financial and the business side. On the other hand, the social distancing piece has worked pretty well in Australia. Obviously, Melbourne's had another big shutdown, which we now seem to be coming out of. But compared to what's happening in Europe and the UK and in the US, we've done much, much better. But for our Australian investments, I think this part of it is still on track. What's not so good is what's happening overseas, where clearly we have international investment. So it's a bit of a mixed bag on this one. And my sense is, if you had to put a probability on what I first started calling the V-shaped recovery, it has started to wane a little bit. It's still the most likely, but it's not as likely as it appeared back in April, March. The other ones, how are we going there? Well, for much the same reason. The flip side, it's a mixed bag on the infection keep rising. Australia, good. Elsewhere, not so good. The vaccines appear like they're about to arrive. They appear like they're about to arrive. They will take, the experts are telling us, somewhere between 8 months to a year to actually get properly out in the community where enough people have been vaccinated in order to have a really material effect. So this is not an instant savior. It's where we are at the moment. It's making this really bad scenario less likely, but we're still a long way from being out of the woods. Similarly, the social distancing lifts too early. Not bad, well, good here in Australia by and large, not so good elsewhere. The good news is we're not seeing any of these last two. Businesses, yes, there have been some failures, but in fact, the average rate of business going to receivership in Australia has fallen pretty dramatically. And it's because the government support have allowed more businesses to keep going than normally would. The failure rates are actually falling at the moment. That will turn around in time. But basically, that side has been really good. The banks have behaved well. Government policy clearly has been a success. So, as I say, it's a little bit of a mixed bag. The highly likely V-shaped recovery, slightly less likely than it was before, but still the most likely event. And the chance of this turning into something, the Doomsday Scenario, which is more akin to the Great Depression, I think is still a fair way away at the moment. This is how we described it back in March, basically saying the economic narrative was the short, sharp shock. We shut down for 3 months, 50% open by September, and everyone's back to normal by 2021. That clearly is not going to happen. The Doomsday Scenario at the other end was we reopened too early, 9 months of then further shutdown, and the economy doesn't really bottom until the middle of next year or late next year, and huge damage is done. Now, there's clearly a number of scenarios in between those two, and the most likely one is somewhere in between, but closer to the short, sharp shock. But that was really just how we were describing it. The most important part is to say, what is going to happen to company profits over a period of time? Because that's what we feed into our model evaluations. And basically we were saying, compared to 2019, we'd see a 40% fall in profits this year, a little bit of a recovery next year, but by 2030, pretty much we would be in a similar position than we would have been without all of this. And so that does have some impact on profitability. The second Doomsday Scenario said earnings fall 60% this year, they fall further next year, and in 2030, they're still below the levels of 2019. That type of scenario is quite consistent with what we saw during the Great Depression in the United States. So when we go back and look at our original scenarios, the first one, it looks unlikely, but more importantly, the downturns in earnings look about okay. If anything, I think they'll probably turn out to be unduly pessimistic. Having said all of that, the odds of getting the Doomsday Scenario are higher, but I would say they're no more than 20%, which is enough to worry about, but not enough to want you to really change strategy at this point. What we can now do is look at both forecast returns as we saw before in our base case scenario, but then say, well, what if things don't turn out well? What if we get our Doomsday Scenario where the path of profits looks very similar to it does in the Great Depression? And what we find there is the returns are, obviously unattractive, 1s and 2s and so on, but they're still going to be better than term deposits. Now, remember I said earlier on that the term deposits, we will roll them over probably at a higher rate. Well, if we go to this Doomsday Scenario, you're going to be rolling your term deposits over at 0 down the track. And so at current prices, notwithstanding that we're getting pretty low returns in this doomsday scenario, we're still going to be better off than being in term deposits. So right now, no matter which one you look at or which one you favor, you're better off being fully invested. And that's one of the things that's been very useful for us going through the last 6 months. And certainly in March and April, these numbers all look much, much higher. And as we've seen this recovery, the forecast returns come down a little bit. And now we get to the stage where things I would describe them as around fair value. If we were to go to the doomsday scenario, you would see a couple of things happen. Firstly, share prices would fall heavily. That would happen before we as a group are likely to identify it, unfortunately. One of the things we've found consistently, and I see it a lot working with many financial advisory groups, professional and financial advisory groups, wholesale fund managers, institutions, is when they start trying to get into this short-term market timing, they just get it wrong over and over again. It is really tough to make calls before the market sees it. So our approach is to think about what is it like to be over the long term. We don't know whether this is going to come out in the short term, the medium term, or the longer term, but we're pretty comfortable with the idea that right now, if we buy assets and hold them for the medium to longer term, we're going to do better in our equities than we are in our term deposits. This comes through to the tipping point tables. The way this works is where the red arrows is at the moment is effectively where we're saying markets are right now. And what we can also do then is calculate, well, look at the first one. If Australian equities were to rise in the All Ordinaries Index from 6,500, go up about 50 or 60%, the forecast return would get down to be less than 1%. At that stage, we're getting less than term deposits. That's in the red zone. When we're in the red zone, markets are overpriced. And that's the point we really want to be taking money away from that. That's a fair way away right now. And most of the time, when you look across this chart, markets are in fair value or just in the cheap zone. Basically, the way this works is if our forecast is less than term deposits, we're in the red zone. If we've got in 5% or more above term deposits, we're in the green zone, and the others are basically in between. So right now, we're around fair value. Worthwhile touching on the US election, and I'm going to go back on this one to really make the point. 2016, I was pretty confident that Hillary Clinton would win. I was also pretty confident that in the unlikely event that Donald Trump got up, it would be really bad for markets. People would look at Trump and say, this guy is not a suitable president, and it's going to be bad. Now, this is some of my own personal political biases coming through. And it turns out wrong on both counts. When Trump won, the markets originally panicked. That lasted for about 6 hours. I think they sell off about 7% and then went on this long bull run. So by trying to pick that one, a lot of people ended up losing a lot of money. Flow forward to this latest election. I listened to quite a bit of commentary leading up to it. And basically, most commentators said, look, if Trump gets back in and retains the Senate, that's probably okay for markets. If Biden gets in and retains the Senate, that's probably okay for markets. The one thing you just don't want is for Biden to win and the Republicans to win the Senate, because they'll just block everything. It'll make it very difficult for Biden to get legislation through. And in particular, the Republicans may decide to block the extension of their version of the JobKeeper program, which would be I think, a disaster for the economy. So what do we get? That's what actually came about. Turns out the market seems to like it. And then we get the positive news on the vaccine and the markets just take off. It's just another illustration, as if we need one, of just how hard it is to time short-term market events, to try and think about geopolitics and say what will happen. We just prefer to just avoid all of this. We're interested in it. We watch it. It can make a difference one way or other, but very rarely will, whether we get a Republican or a Democrat or a Liberal or Labor, very rarely will it change enough to make a market that we think is cheap into expensive. Very rarely will take even from fair value to fully priced. So by and large, it doesn't matter too much. it's interesting, it's fascinating, but as far as an input to our investment process, we pretty much ignore it. Another one I'm just going to touch on, mainly because most of us have fairly significant positions here, and that is in the banks. And typically we'll have two positions. We'll have some equity, but also we'll have some position, often through bank hybrids, which are in the fixed interest, the defensive part of the portfolio. So the things I'd like to say about that, firstly, earnings have fallen, and I say sort of. The reason I say sort of is the big driver in falling earnings in the banks have actually been allowances they're making for loan losses. So these are provisions. These aren't actual loan losses. This is the banks sitting around going, okay, we're in a recession. We know we lose money in recessions. We make loan losses in recessions. How much do we think it is? And I can imagine the way a lot of the banks' managements have approached this. It says, okay, put up your hand if you've been through a pandemic before. Of course, no one has. So what number are we going to choose? And the number they're going to choose, I think, in most cases, is going to be, let's put as big a number aside as possible, which is not going to upset the regulator and tell us we need to get more capital. Because when they need to raise more capital, they have to sell more shares. You have the same number of profits divided amongst more shareholders, so their earnings per share goes down and the share price goes down. And I think by and large, that's about the level of losses they've declared. And what that is provisions against future losses. So if future losses are lower than they've put aside, then actually will have no impact on earnings. In fact, they'll make them go up a little bit. My guess is, and this is the early evidence is coming through this way, that they will have over-provided. So we've probably seen the worst. Having said that, the numbers they're stating look low in terms of earnings and so on. So what we do to get around that is we look through to 2022 and say, what are earnings going to look like then? And out of that, work out what is the expected 10-year returns. The one other thing I will touch on is their capital position, because I mean, people are rightly concerned in a recession, are the banks adequately capitalized? If they're not adequately capitalized, they may not survive. And we saw that during the GFC, where a number of US banks, UK banks just effectively didn't survive because they didn't have enough capital. So here's the return. I think the banks look really cheap right now. This was based on, I think, Friday night. I think they've gone up a little bit since then. But if you look at the yields, by and large, including franking credits, we're getting 5 to 6%. And this is assuming we don't go back to the old dividend yields. Earnings growth ought to be around about 2.5% for the banks. And that's based on them putting aside enough of their profits to grow their capital base. Because I think one of the things we are going to see is quite a big growth in home loan lending activity, really driven by the much lower interest rates, which means if you turn up today to get a home loan, they will give you more money than they would have given you a year and a half ago. And so I think that then drives lending growth, it drives housing prices, a number of things. The final one is the change of price earnings ratio, which is, how much will the market pay for $1 of profits? Currently, if we look at ANZ, the market's paying $12.60 for $1 of profits, much lower than it's paying for most other stocks in the market. And I suspect that can go up a little bit, not hugely, up to say 14.5. That adds about 1.4% to returns. We get a 10% return. And we get something similar for NAB and Westpac. The one that's a little lower is CBA, where the market has got pretty comfortable with CBA earlier than the other banks. I think it's largely because they've got more of their business activities around the home loan area, which is a safe place to lend money. And so I think we get very good returns out of the banks going ahead, even after some of the strong increases we've seen recently. In terms of capital position, I'm not going to go, you'll be saying thankfully, not going to the numbers here, but basically what we've done here is say, how much money did they make last year? And the CET1 is something the regulator APRA looks at, which is how much capital do they have? How much shareholders' capital they have for each dollar of lending activity. And basically, they want to target around 10%. The idea is if 10% of all their loans go bad, the bank is still not broke. And it really happens that way. So what I've then done is that second block is, what if we have a GFC style recession or downturn with a similar kind of losses, some big losses to property developers. I've also increased the losses that you'll get out of your home loan book by 4 times, whereas in the GFC, the banks lost almost nothing out of their home loan book. What happens to profits? They're down about somewhere between 20 and 40%. In other words, not great, not catastrophic. That's actually pretty close to what they've provisioned for right now. These are not real losses though they've got right now. It's assumed losses, but I think that's probably not far from the case. And that's assuming the downturn is of a similar size to the GFC. The second part about it is, what if it gets much worse? I've got 5 times GFC losses. This is much closer to the Great Depression. It's like our Doomsday Scenario. And there, loan losses on residential property go up by 20 times. 1 in 5 developers' loans are completely lost. Business losses are 5 times as big as they normally are. And that is enough to more than wipe out profits. What is really important about this one, particularly from the point of view of our hybrid investments, is that capital ratio, which the regulator targets, stays at around 6% or better. Now, 6% is a bit of a magic number. In the event that capital ratio got below 5 and 1/8, then the regulator could say to them, we want you to convert your hybrids into bank shares. Now, what was much more likely to happen on the way is, if something like this scenario unfolded, the regulator would be saying to the banks, you need more capital, you need more capital. They would be forcing the banks to sell more shares, increase its shareholder base, and so we'd never actually get here. But that's an important piece to say. We are really, really unlikely to see any of these banks get into serious trouble, and certainly unlikely to see any of the hybrids get into serious trouble, which is important because we've got them in the defensive part of the portfolio. One final thing we look at the banks, this comes out of a study that was done by the Reserve Bank, where they went back to the early 80s and said, when we have a recession, what seems to drive whether banks make big losses or small losses in those recessions? And they came up with 4 big factors, which are pretty obvious when you think about it. One is very high rates of credit growth leading into the recession. Secondly, declining lending standards. Who would have guessed? The other one is high levels of construction activity. And fourthly, rising interest rates. So this is a bit of a roadmap or a checklist of saying, well, how are we on those factors? Credit growth is very low, and you can see that's the top left-hand side of this one. And you can see it was much, much higher leading up to the GFC. So we're in pretty good shape. We give it a green light. The second piece is bank lending standards. This is not always easy to get a handle on, but the important one is that orange line, which is, what is the level of interest that companies are paying as a share of their profits? And you can see that's very low, which is suggesting lending standards are solid. The other one, the blue line above, basically said, what are new loans as a share of the overall economy? So if that's going up rapidly, as it was in the GFC, it suggests banks are relaxing their lending standards. So once again, green light. Similar type of piece there is, that one is how much of household income is going away on paying interest payments. Very low. And so we kind of say that's good. The 2 on the bottom left and center are basically construction, both non-dwelling and dwellings. Fine. We've still got a red light on the residential construction because I think that one has about a 3-year lag. We get their building approvals. A year or so, they've got all the finance in place. They start putting the building up. It takes a couple of years to complete. So I think there could be a few losses lurking around on that one. But in the overall scheme of things, not a big deal. And the final one, interest rates just are not going up anytime soon. So banks are in really good shape to weather this recession, and all the early indicators suggest that's actually spot on. Commercial property, an area we've really liked. Basically, when we look at listed property, which is the preferred way of getting an exposure there, we've got a return about a little over 6.5. And people go, oh, you know, surely malls are going to be in trouble, the shopping centres. Surely offices are going to be in trouble. Well, we've assumed that office rents will fall 30% from here over the next 10 years. That's in real terms. We're assuming that shopping centre rents will fall by 20% in real terms. And then even after that, we're still getting a reasonable growth rate, a lot of which is coming from their funds management activities. A lot of these listed property entities do funds management sort of on the side, and that area of their business is doing really well. So really comfortable with commercial property, even putting in some very pessimistic assumptions. And obviously they've done very well in the period following March this year. I'll just touch quickly on interest rates. Interest rates we see likely staying low for decades. I'm going to touch on basically how the RBA operates and the level of housing debt and how those two interact. Now, you basically, as I'm sure you all know, the RBA manipulates interest rates in order to regulate inflation. So the idea is if inflation's getting a little bit out of control, as it was in the 80s and early 90s, they lift interest rates, slow down the economy, take some of the stresses out of the system. When inflation falls, they will drop interest rates somewhat to try and get economic activity going again. And you can see the size of the moves they made. Mid-80s, interest rates were increased by 14% up to over 18. Then there was another big spike in the late 80s where up 8%. The more recent increases have been much more modest. Now, while all this has been going on, Australian households, again, as I'm sure you're aware, have been taking on much more debt. Almost all of this is to finance residential property. So if you go back to 1983, if you looked at the average household, their total debt was under 40% of their total income. Today, the average household has more like 180% of debt to income. Now, what this means is if the Reserve Bank lifts interest rate by 1% today, it causes 4 times as much pain in the household sector today as it would have in 1988. And so those big increase in interest rates are actually, they could do a much smaller level of increase to get the same amount of pain. So for example, that 14%, when you adjust for the amount of extra debt, by lifting interest rates by 2.6, the Reserve Bank would effectively throw the economy into a recession because there's so much more debt in the system. And you can adjust all of those increases for that. And what you find is, in order to get from where we are today in terms of debt, the economy either to slow down dramatically or go into a recession isn't going to take much more than 2%. And so in this next cycle, where the Reserve Bank finally gets around to say, look, it's time to lift interest rates again, I'd be really surprised if rates go up by more than 2%. That gets us to about 2.25%, maybe 2.5%. And so that's the really think why we say interest rates are going to stay low for a long time, because until that debt is paid off, 2.5% is enough to kill the economy. So we are really unlikely to get interest rates much above 2.5% for a long, long time. This is slightly better news, but only just. TD rates seem to be getting close to a bottom. It seems like the banks have targeted, they want to pay TD rates about 0.5% higher than government bonds. Now, clearly you can see back prior to the GFC, they paid much lower than government bonds. But since the GFC, the regulator was told them they need more deposits from personal investors in order to make their books more stable. And so they pay a little bit more in order to attract that money. It seems like we're getting down to those low levels, but there's a reasonable chance that TD rates could go close to zero. This is from a few years ago in the United States. And if you look down, basically what it says is, it doesn't matter how much money you've got or how long you're prepared to invest for, you're not going to get much out of your TDs. Even a 5-year TD there with $100,000 or more, you're getting 0.07%. The reason for this was this whole piece around quantitative easing. Without getting into technicalities, the central bank floods the system with money by buying back people's bonds, creates money to do it. It ends up back with the commercial banks as deposits, and so they don't need to compete anymore, and so they don't pay anything. Whether it's going to go this way in Australia, I don't know, but it is a real risk. So as low as you think TD rates are at the moment, there's a chance they could go lower. All this says we have to look much more closely at corporate debt, where it's a little bit more risky, but there's a huge range of risks involved, and I'll touch on that quickly. But you're getting well rewarded for that. Now, most of you will have some bank hybrids in your portfolio. That is a form of corporate debt. And the amount they pay above cash has been really good, sort of 2.5, 3, sometimes more. And so we think that Australian banks, particularly the big four banks, are a really safe risk. And it's one of the reasons we do all that agonizing analysis you saw earlier on to say, are they as safe as we think they are? So we've used those extensively. The next step is, so what are other types of securities we should look at? Now, when a company borrows money, most of the time they get a rating from one of the credit rating agencies. AAA is the safest. AA is pretty good. A is good. Triple B is the bottom rung where they say you are investment grade. Investment grade says you're pretty unlikely to fail, and this is a good deal. Typically, investment grade bonds pay 1.5 to 2% better than government bonds, so it's quite a good pickup. And there is the occasional failure, and that normally costs investors about 0.2% on average across a broad range of assets. But what this means is, if I'm investing in a well-diversified portfolio of triple B type assets, I should be beating government bonds by 1.3 to 1.8% per annum. I think that's really worth it. And what's more, when you look at the worst case failure rate over the last 40 years, it only ever got up to 0.8. So it's really likely over a full cycle, you're going to do better. So that's one that I think we'd be likely to be targeting. The downside on that one is these securities are listed and they can be volatile. And it sort of can be what I would call sort of dumb volatility. It doesn't reflect real risks. It's just everyone panics together. And we saw some of that in March. But I think that's a likely place we'll be looking. The other one that is really interesting, and there's a fair bit of work to be done on this one, it's looking at non-bank lenders. The banks, the Australian banks, have vacated a lot of their lending activity, lending to developers in particular, lending to smaller businesses. And that has created an opportunity for non-bank lenders to come in. And often the loans involved are secured by hard assets. So for example, if a property development was taking place, the lender might give them 50% of the value of the development, and they effectively have first charge over the assets. If they do it really carefully, it's hard to lose much money on that. It's certainly possible. And they'll typically earn something like 5 or 6% per annum. This is more risky than traditional fixed interest without any question, but it's less risky than shares. And in this environment, it's an area we're looking at very carefully and trying to work out how does that best fit into the portfolio. Do we take a little bit of money out of equities? Do we take some out of the defensive portfolio? But that's a kind of a watch this space. So there's our forecast returns. This is where we come back to the strategy piece. They're all well ahead of TDs. And so what we then do, and this is going back to the buckets that Graham was talking about, we look at the weights we have. We call them neutral weights. The neutral weights is if everything was at fair value, what sort of weight might you have? And right now, most things are one close to fair value and not very different from each other in terms of whether they look attractive or unattractive. So we're pretty much at neutral weight everything, which is kind of unexciting, but there will come a time when these weights will move around. And it's typically when we're getting up into that yellow zone of the tipping points or the red zone of the tipping points. And obviously your advisor will be talking to you about that at that time. And if it happens, it's good news because all the share prices will have gone up. So in summary, we're still expecting a V-shaped recovery. We're expecting reasonable returns from equity and property. not as exciting as they certainly appeared earlier on in the year. More importantly, interest rates stay low for decades, and that's what makes these returns reasonable. And we're looking closely at credit, corporate bonds, to see where are the opportunities in that. So perhaps with that, I can pass back to Graham to see if we've got any questions.
Thanks, Tim. What I'll do is I'll just switch my camera. We do have a question. I'll just, if you just bear with me, I'll bring it up. Sorry. So the question was from Richard Gould, and it's essentially regarding the banks. Now, I know you dealt with the banks a little earlier on in the presentation, so perhaps I can go back up to that slide, which might help. But in particular, it was in relation to the penalties that have been applied by APRA and ASIC.
Yeah.
And what in terms of what impact that might have in the overall scheme of things?
Ultimately, what it's meant is, though they haven't made as big a profits in the last year as they would have expected to have made. What that means is, while they've got plenty of capital today, in order to get the amount of capital they need to support their activities, the first thing they've done is cut their dividends. And so by cutting their dividends, if they're expecting to pay out 80% of their profits as dividends, which is where they were before, and they've only paid out 35 or 40, they're now starting to pick their capital, their books up a little bit. So that's one piece of it. The other piece is, you would hope that they at last are starting to learn some lessons. They certainly appear to be. And so these losses, I don't think are going to be a permanent part of the landscape. And if you looked at the profits we had on that table, their earnings there, if you go back one more. Yeah, that one. The earnings that are inherent in these price earnings ratios are still lower than the ones they made last year in 2019, with a lot of those remediation payments in there. So I think, if anything, these numbers are conservative. And if they continue to make the same mistakes year in, year out, you'll probably get these kind of returns. If they can manage to eliminate those mistakes, and you'd think they'd have to, returns will probably be better than this. So the banks are one area where I think look extremely attractive. People just get overly negative about the banks. And I think they're a really bright spot at the moment in terms of expected returns.
Thank you. So just in terms, we've still got a few minutes, just if anyone wants any last minute questions in the Q&A. So please type away, but just if and when that's happening, I might just ask one further question to you, Tim. Just the impact of China on any economic recovery that we might be looking forward to. How do you see that as a...
It's really fascinating, particularly because there's been a lot of talk around the conflict that's building between China and the United States. And the United States is our security partner, but China is our greatest trading partner. And in the event that, push comes to shove, which way do we go? And if we were forced to turn our back on the China trade, I think that would be really serious for Australia. Having said that, our biggest exports to China are metallurgical coal and iron ore, which is used in the steel-making process, thermal coal, and education. Now, you think about those ones. The steel-making process, one of the great advantages that we have is our inputs are much, much cleaner than basically anything you get anywhere else in the world. Now, in terms of the problems the Chinese leadership faces, pollution is one of their key priorities to try and eliminate that. So I think the chances of them saying, oh, we don't want Australian iron ore, we don't want Australian metallurgical coal, that's the coal that goes into the steel-making process, are really low. Firstly, because pollution's so important to them, but secondly, if they say we're not buying food, there isn't anyone else. The Brazilians just simply cannot produce enough. And so that part of which is our big base looks okay. And then the next one, you start thinking about education. Well, the Chinese have done a great job eliminating the coronavirus. And Chinese kids do like to go overseas to study. And presumably Chinese parents like their kids to come home every now and then. So are they going to go to the States? Absolutely not. Are they going to go to London? I don't think so. Are they going to go to Europe? I don't think so. So, who knows? We may end up creating some sort of education bubble with China where actually we end up being much closer than before. So my sense is, in the event that things get really nasty between the United States and China, the Chinese will be much more interested in making some symbolic gestures. So, we won't have your barley. We won't have your lobsters. Things that actually don't make a big difference to us. And the things that really do make a big difference, I think they need us as much as we need them. So I think they find a way. The other piece about it is, I'm not sure where Biden comes out, whether he's someone we should be pleased about or not. The people who know much more about this than I say that Biden is every bit as anti-China as Trump is, but that unlike Trump, Biden is more likely to look for support from his allies. So, he'll be looking for symbolic gestures from us, and the Chinese hate them. Yeah. So, in some respects, Biden could be worse for us in terms of that relationship piece. He may be much more moderate. We just don't know. But in any event, I think the more important piece of it is, given their goals of getting pollution under control, I think from an education point of view, from our key exports, we're actually pretty safe.
Yep.
And one other thing is, the Chinese economy is doing better than any other economy in the world right now. If you could pick any partner to say, look, this is the one we want to have as much activity with, they would be the ones. So far, I think it's okay.
Yep. Thanks for that. There's a couple of questions coming through. So maybe we'll sort of give a couple of minutes to each of them. So first one is from Jeff Harrison. Thanks, Jeff. What's currently the most attractive to invest in, Australian or international shares? So what I might do, I'm sure you probably want me to talk to the tipping points, Tim, if you want.
Yeah, it looks much the same is the first thing. It's a little bit different, but not hugely so. The interesting part about it is, when you break down that developed markets, the US looks less attractive, which by definition, the rest of the world looks more attractive. I didn't have a chart on it. So I think outside of the US is more attractive than inside. And it obviously has not performed nearly as well outside the US than inside the US over the last 5 or 6 years, but that's why it looks more attractive. And in a similar but a different way, inside of Australia, I think the banks look hugely attractive compared to other parts of the market. So if I had to pick two areas, I'd say the banks and non-US equities is the ones that stand out. If you'd asked me the question a month ago, I probably would have said A-REITs as well, but they've gone up, 15 or 20% so far this month. They've had a huge run, and it's just made them, they're okay. But it's less exciting than before.
Thank you. I've just there's another one here from Shane Brady. So thanks. He writes that just struggling to understand how commercial property will have any upside for years to come unless an alternative use is found for these properties. People working from home, buying online, has it changed the landscape for commercial property? Can you sort of help me understand how you might think commercial property will improve from here?
Yeah. Okay. If for example, we split out the funds management activities of the REITs and just had a pure property exposure, I would tend to agree that your growth expectations certainly out of the malls, the shopping part, the malls and offices is pretty close to zero over the next 10 years. And in that event, you'd be saying, oh, I'm going to get a yield. I haven't looked it up recently, but I think your centre groups and things like that are yielding about 7%. So no growth, I'm getting a 7% return. I'm not unhappy with that. Similarly, offices, it's quite interesting. A lot of the offices are still finding that I think 90% of their tenants are paying up on time, which is a bigger number than I thought they would be doing. I think that will go down over time as some of the government subsidies go away. But in its place, what a lot of certainly the larger organisations are doing is saying, instead of having, I can't remember what it was, one person per 5 square metres, we now want 8 or 10 square metres per person. So in order to put the same number of people in a given space, on a floor, in order to have the same number of people, they need double the space or 50% more space. So I think that is going to help a bit. But having said that, the forecast we have is commercial or office property rents fall by 30% over the next 10 years. Now, whether that'll happen in a hurry and then creep back up again doesn't really make a dramatic difference to returns. So yeah, from the fundamentals, you look at it and go, ugh, but the prices have fallen by so far. So for example, I think since the start of the year, from peak to trough, the shopping centre groups were down, I think it was about 70%. So the question you ask yourself is this property really worth only 30% of it was, 6 months or 3 months earlier? I'd say no. And part of the point is, I have the name of the questioner was saying, well, if an alternative use can't be found, a lot of this property is in really great positions. They will find other uses. Out in Chadstone, I think they've got a hotel in there now. They'll put residential accommodation in there. Over time, they will shuffle the way these things work. And I suspect that the alternative uses for this land and areas is such that it's worth it's probably worth at least 70% of what it was at the start of the year, whereas the market said it was only worth 30 cents in the dollar. It's just the market overreacted. So yes, the fundamentals have deteriorated, but the prices deteriorated much, much more quickly. And that's why they become attractive.
Yeah. And just on this slide, I'm hoping you can see it there. The income that you've assumed for listed property in the middle there, you say that factors in an assumption that rents will be 30% down. Is that
on offices and 20% down? But the other part of it is there's a reasonable number of industrial properties in there, the logistics as they now call them, which is really catering to the whole online commerce trade. And I've got those still growing their rents by about 2% per annum. And the other one is, which I think I mentioned all the way through, a lot of these funds have really significant funds management businesses, which are growing pretty rapidly. And that all kind of comes for free. So it's more than just buying commercial property with rents. It's the way the companies in that sector are structured.
right? Well, thank you, Tim. We are sort of 10 minutes over or so, so we might wrap it up there. For anyone, I guess, thank you to everyone who attended today. It was our first sort of go at a Zoom webinar, so hopefully you found it informative. Certainly send any feedback through to your advisors or back through the First Financial website. And I think we've recorded this, so there may be the opportunity to watch it back through the recording as well. So I think we'll send a link. But without further ado, that'll be wrap it up for now. So thank you, Tim, for your time.
Thanks, Graham.
Appreciate that, and thank you to all our clients for your ongoing custom, and hopefully you found today valuable. Thank you.